Welcome back. Islamic finance is far more nuanced than simply being interest-free finance. Its ethical guidelines actively aim to remove injustice and inequality from financial matters. These principles are designed to create a more stable and equitable financial system by tying finance directly to real economic activity and shared risk. Let's explore some of these key ethical rules that must be followed in Islamic finance and consider their implications for financial stability. Prohibition of riba, interest. As mentioned, this is the most fundamental prohibition and is unanimously agreed upon by Islamic scholars. The underlying ethical rationale is that money, as a medium of exchange, should not generate more money through simple lending without real economic activity or risk-taking. Risk-sharing and no riskless return. A cornerstone principle is that you cannot earn a return or profit unless you are willing to take some risk. In Islamic finance, there is fundamentally no riskless return. Anyone willing to invest their money must be willing to accept a loss if the underlying venture doesn't work out. This directly counters the conventional lending model, where a return is guaranteed regardless of the borrower's business success. This principle encourages genuine partnerships and shared destinies. Example, trust financing, mudaraba. This is one of the simplest financing structures. One party, the investor, provider of capital, entrusts their money to another party, the investment manager, entrepreneur, to invest in a Sharia-compliant project. Profits are split between the parties based on pre-agreed ratios. However, crucially, losses are borne solely by the capital provider, as the manager-entrepreneur only loses their time and effort, or sweat equity. This principle aligns with the capitalistic principle that the higher the risk one is willing to take, the higher the return they can potentially earn. Analogy to conventional finance. This structure is similar to mutual funds or hedge funds, where investors bear the investment risk and the fund manager earns a fee or a percentage of profits, as with hedge funds' 80-20 profit split. In Islamic finance, this is permissible provided the underlying investments are Sharia compliant. Investor equality. All investors are treated equally. One investor is never favored over another. This prohibits structures like conventional preferred shares, which give priority claims on profits. Prohibition of selling what you do not own. This principle directly forbids speculative practices like short selling prevalent in conventional financial markets. You bet that a stock price will fall, so you borrow shares from another investor and sell them without ever owning them. In Islamic finance, you must own an asset before you can sell it. This significantly reduces speculation and volatility stemming from transactions detached from real underlying assets. Example, cost-plus financing, murabaha. If you want to buy a car but need to pay for it later or in installments, an Islamic financial institution would first buy the car from the seller, taking ownership and the associated risk, and then resell it to you at a higher price with deferred payments. The institution justifies its profit because it took on the risk of owning the asset and provided the convenience of deferred payment. As Al-Rifai highlights, the bank will most likely respond by telling you that they are not a car dealer, they are a bank. They have money to sell you and not cars, illustrating the fundamental difference in risk-taking and asset involvement between Islamic and conventional finance. Productive investment. Money must be invested in something productive to earn a profit. Hoarding money or letting wealth sit idle is discouraged. Money cannot earn a return simply by existing or sitting idle in a bank account. It must be used to produce value and be subject to risk, profit and loss in a real economic venture, company, or asset. This encourages capital to flow into tangible, value-creating activities. Transparency and minimizing ambiguity, gharar. Any financial dealing must have transparency, with ambiguity and uncertainty, gharar, minimized or removed. This means all defects and issues must be disclosed, whether buying a car, a house, or investing in a company. This fosters trust, reduces information asymmetry, and ensures that participants make informed decisions, directly combating deception and misrepresentation. Prohibition of gambling, maisier. All forms of gambling, maisier, must be removed from a transaction. This principle directly addresses highly speculative activities that are not tied to productive assets or ventures and involve excessive uncertainty or pure chance. Money as not a commodity. Money in Islamic finance is seen primarily as a medium of exchange, not a commodity to be bought and sold for a profit. This differs fundamentally from conventional finance, where money itself can be traded and earn interest, leading to the money-making money phenomenon independent of real economic activity. This also influences how money supply is viewed and controlled, ideally not linked to debt.